The U.S. Federal Reserve is in the process of raising interest rates. The idea is that by raising the cost of borrowing, raising the cost of money, that there's going to be less consumption, and that's how ultimately you get inflation under control. The U.S. is dealing with its highest inflation rates in 40 years. We're seeing it in raw commodities, we're seeing it in energy, we're seeing it in housing, we're seeing it in baby formula, and until we find a balance between supply and demand, this is going to be our normal. Interest rates are the tool that the Federal Reserve has. But it's not just the Federal Reserve in play here. There are other major countries dealing with similar issues. The problem for them is they can't raise interest rate. If you look at Europe or if you look at Japan, these are economies whose demographics have aged so fast that all of them have more people in their 50s than their 40s and their 30s and their 20s. And since economies with a lot of people in their 20s and 30s are where most consumption comes from, these countries are probably never going to have positive interest rates again. Europe's already been at 0 for the last decade, Japan for roughly 2. They cannot emerge from this. If you look at the other major players, say Sweden or Denmark or the British pound, it's not quite as bad. They do have better demographics. But Sweden and Denmark joined with the Brits and the Europeans in supporting sanctions on the Russian system, and they're kind of at ground zero for feeling the economic effects. So while they are experiencing inflation that is uncomfortable, they feel they don't dare raise interest rates for the risk of choking off whatever economic growth they might be able to have in an environment where we have shortages of everything because of the Russians. In case of the British pound, it's even worse because the Brits still don't have a plan for what happens after Brexit. So anyone who wants to invest in Britain just has a huge amount of uncertainty. The only other country of note is China, but the yuan is not internationally traded because the economic system there is now so stilted and because of lockdowns so shut down that if they were to open their economy to the wider world, you'd have a huge amount of capital flight. They can't tolerate that. So only about 1% of the circulation of the Chinese yuan is actually available for international exchange, and most of that is in Hong Kong. You add on top of that the Chinese tend to print currency at 2 to 5 times the rate of the United States, and they're monetizing their entire system in a way that the States has never even considered. Now, where does this take us? Well, a lot of the world's economies, the krona in Denmark, the Swedish krona, the European euro, the British pound, the Japanese yen, the Korean won, the Australian Kiwi dollars, they're all de facto linked to the United States' system now because of the sanctions that are going on in Europe. That means that we have a country that has all the demographic strength, the United States, and a country that has the global currency, the United States, and a currency that everyone else is taking their cues from, the United States. That suggests that the US dollar has nowhere to go but up for years to come. And on top of that, we have a bond issue. Now, because all of these countries around the world can't raise interest rates, when they issue debt to get people to buy it so they can fund their government, they have to offer terms that are around 0. In fact, we've got $2.5 trillion of international debt, government debt, that is actually earning negative returns compared to the United States. The United States is the beginning of a very long series of interest rate increases in order to get inflation under control, but no one else is. That means the differential between American bond yields and global ones is just going to rise and rise and rise and rise. And that means we're going to see huge volumes of foreign capital flooding from the sovereign debt markets of the rest of the world into the United States. Because would you rather have like a negative 1% return or a 3% return? That suggests that the United States is going to be able to borrow at lower prices for a longer period of time than anyone has factored in. And as long as the US economy remains consumer driven with its relatively healthy demography, that is going to be for decades to come. Bottom line, even now, in a period of inflation, probably at the turning of the business cycle, where the baby boomers are moving to retirement and taking their money and consumption with them, the US still looks pretty good, in part because it's doing what Ross Perot so eloquently put, that giant sucking sound pulling the money out of the rest of the world. A lot of the tools that we have developed
to regulate the economic system, most notably interest rates at the federal bank level. We're not sure if they're going to work anymore. The whole idea of interest rates is that you make the cost of borrowing higher so that demand becomes more expensive so that people and companies do less of it. But for that to work, you have to have consumption as a primary driver in your economic system. Most of the world doesn't have that any longer. Most of the advanced world hit the point of no return with their demographic aging back in the 90s, and places like Germany and Italy and Japan now have more people in their 50s than their 40s than their 30s and their 20s and so on. Now in the United States it hasn't hit nearly as hard, but we still have this huge generation, the baby boomers, who are retiring, and a very small generation, the Zoomers, who are coming into the system. Right now, in calendar year 2022, that's a shortage of 400,000 workers. And by 2034, that number will have increased to 900,000. This is structural inflation. This is a problem on the supply side. And when you raise the cost of borrowing, it doesn't just impact people who are trying to buy a car or a destroyer. It also affects people who are trying to build out industrial plant and productive capacity and train new workers. It's not clear to me whether in places where this demographic decline is advanced, such as Germany, where interest rates even work anymore. Because you are capable of strangling now supply with it, and it doesn't do anything to demand because there isn't any. The economic rules of the past may not apply anymore. Now in the book I call this something called the end of more. The idea that every economic model that we have developed in the last 500 years, whether it's fascism or socialism or communism or capitalism, they were designed for an environment where the pie got a little bit bigger every year, largely because of population growth. That's no longer true. When you look at the problem that the U.S. Federal Reserve is dealing with right now, they would like to get inflation under control, and interest rates are the tool they have. But if we're in a world where the normal relationships between demand and consumption and supply and production are somewhat out of whack and might not go back, it's not clear to me that they can raise interest rates to dampen demand without also crushing supply, because we've never had a significant problem on the supply side before. And because we are now facing the greatest labor inflation in American history, raising interest rates just might not be the right tool. And then it comes to the executive branch, and that's a whole other discussion of whether the Biden administration is up to the challenge.
The labor crunch situation in East Asia is far worse than it is in the United States. Because while we have millennials, they don't. And they also have something called the one-child policy, which has been gutting the Chinese demographic for 40 years now. And China is now the fastest collapsing demographic in human history. And there is no way the PRC survives the next decade in its current form. They just don't have the tax structure and the labor structure to even try. So this was always going to fail this decade. So you never want to rule out something like a coup. It could happen, but if that did happen, it's difficult to see whoever would pull it off to be able then to control the country on the other side of it. They might be a regional leader and they might be fine for their region, but the rest of the Chinese system would have a different opinion on who should be in charge.